If you're like most traders, you're probably looking for a strategy that will help you maximize your profits while minimizing your risk. Let's face it, that's easier said than done. But what if I told you that I discovered a trading strategy that will help you accomplish minimal risk and maximum reward? This strategy works extremely well on the cryptocurrency market, with the best time frames being 1, 3, 5, and 15 minutes. The setup includes 3 TradingView indicators, which we'll go over one by one. The first is called the Zones Detector by Kalahi, and its main function is to identify supply and demand zones in the market. Those zones can be quite useful, but we won't need them for our strategy, so go to the indicator settings and disable the zones in the style section. As you can see, these buy and sell signals are very different from signals issued by a regular indicator. Regular buy and sell indicators, such as a super trend or a channel exit, alternate their signals, which means that after a signal to buy, there will always be a signal to sell. So, if you miss the signal, you'll have to wait for a new one, which may show when the trend is over. This indicator, on the other hand, can generate a large number of buy or sell signals in a row, which may be advantageous for the second indicator, to which we will add a script called the mean reversion channel, which was developed by Farid. This indicator identifies strong and weak overbought and oversold levels by combining the channel, the main reversion line, and the support and resistance lines. We will need to make some minor adjustments to the settings, so open the inputs and change the outer channel size multiplier from 2.415 to 2. When the price approaches or enters the upper channel, this indicates overbought market conditions, and traders usually place sell orders around this area, causing a price decline. When the price reaches the lower channel, this indicates oversold market conditions, and a lot of traders close their trading positions, which no doubt results in a price reversal, but these price reversals aren't that strong in a heavily trending market. So, when the market is in a strong uptrend, the price often continues to move in the same direction. After such a pullback, the selling pressure is simply not high enough to completely reverse the market. This is why many retail traders who go against the prevailing sentiments, believing that the market is overbought or oversold, do not get a chance to profit at all. The price simply reverses and triggers their stop losses, leaving them confused. You want to be smarter than them, which is why I devised the following strategy. By the way, there is still one component missing, which is known as the smooth moving average. Make sure you add this one by right here, with a length of 200. The smooth moving average, the calculation of this indicator does not reference a specific or fixed period, rather uses all available data in the series for analysis. This is a perfect indicator for determining the overall trend of the market. When the price is closed above the SMA, this signals an uptrend. Only long trades can be taken during this time. A downward trend is signaled when the price is closed below the SMA. Only short trades can be taken during this time. So, how should we use these indicators to find sniper entries? Here's the precise strategy. In order for a buy signal to be verified, the following conditions must be met. First, the price and the channel must both be above the SMA. Second, the price must pull back into the lower channel. And finally, the indicator must print a buy signal immediately after the pullback. Open a long trade with a stop loss below the recent swing low. Target 2 times the risk, and move the stop loss to the break-even price once you have made a quarter of the profit. For example, if you risk 2% of their account balance per transaction in order to profit 4%, the quarter will be 1% once you've set a stop loss to secure the trade. The price and the mean reversion channel must be present for a sell signal to be legitimate. All below the SMA, the price must approach the channel, and then the indicator must issue a sell signal, setting the stop loss above the recent swing high and targeting 2 times the risk. As with long trades, once you've made a quarter of the profit, adjust the stop loss to the break-even level. Because of the specific entry conditions, it is quite clear that the strategy does not produce a large number of legitimate entries. However, if you want to increase the number of them, you can make the following changes. Make the mean reversion channel tighter by setting the multiplier to 1.5 instead of 2. You can also change the SMA time frame, which will affect the amount of signals. For example, if you're using a 3-minute chart, set the SMA time frame to 15 minutes. Obviously, these adjustments will reduce signal accuracy, but you can compensate by adding a volume or secondary confirmation indicator to the chart. Okay, so now that you know the trading setup, let's actually do our backtest on a 5-minute time frame and see if the outcomes are reasonable or not. I just finished the backtesting, and these results have surprised me. Our win rate is 70%, and the profits end up at 11%. I would also like to mention that these results will be different when trading live, so always try the strategy for yourself before using it. Guys, feel free to run back and forward testing on various markets and times to gauge how well it performs. If you want to see one of my other trading strategies I use when day trading, check this video right here, because this strategy works great on the every time frame you want. I'll see you guys next time.